If you were to step outside right now, look around, and just try to take the temperature of the world on this exact day, April 24th, 2026, you'd probably feel like you're living in two completely different alternate realities at the exact same time.
Oh, definitely. Yeah. It is a genuinely fractured picture right now. You
Yeah.
really have to squint to see how these two realities are even coexisting on the same planet.
Right, because on one hand, if you look at the physical world, I mean, we are in the middle of a massive geopolitical crisis.
It's huge.
There is a literal naval blockade and an ongoing war in the Middle East. And it's causing the worst global oil disruption in history.
Right, which is just completely shaking the physical supply chains that, you rely on every single day.
Exactly. We are talking severe structural chaos, but then you pull up your brokerage account on your phone, and the stock market is essentially like throwing a massive party.
Yeah, celebrating record-breaking highs. It's wild.
It makes no sense.
Hmm.
So that is our mission for this deep dive. We've got a massive stack of the sources you shared with us.
Some really great stuff in there, too.
Yeah, internal reports from J.P. Morgan, Crestwood Advisors, Zacks Equity Research, and StoneX. And we're going to use all of this to decode what people are calling this two-speed market.
Which is exactly what it feels like, two totally different speeds.
Right. We need to figure out what is actually happening to the global economy when the physical world is literally on fire, but the digital economy is just seemingly untouched. Okay, let's unpack this.
So to understand this bizarre behavior in the stock market right now, we really have to start with the physical world.
The messy stuff.
Exactly. The anchor that is currently dragging the global economy down is this geopolitical crisis.
Right, the 2026 Iran war. Let's look at the facts on the ground as of today, because this conflict has led to the effective closure of the Strait of Hormuz.
Which is a massive deal.
It really is. This is a waterway that usually handles 20 million barrels of oil every single day.
20 million, yeah.
That is roughly 27% of all global maritime petroleum trade.
More than a quarter of the world's seaborne oil just halted. I mean, the International Energy Agency is characterizing it as the largest supply disruption in the entire history of the global oil market.
Wow.
And it's really vital to understand the mechanics of how we actually got to this total closure.
Yeah, the timeline of the last couple of weeks is just intense. So on April 12th, we had these Islamabad talks, right?
Right, which completely failed to reach any sort of diplomatic resolution.
And then the very next day, April 13th, President Trump ordered a U.S. naval blockade of Iranian ports.
A massive escalation.
Yeah, we've got the operation being led by CENTCOM Admiral Brad Cooper, and it involves over 10,000 U.S. personnel.
And, a blockade of this magnitude doesn't just mean a few ships turning around in the Gulf.
No, not at all.
This is a massive logistical operation. They're essentially shutting down a sovereign nation's primary economic arteries.
Right. And the estimated cost to Iran's economy right now is around $500 million a day.
A day. It's staggering. And meanwhile, Iran is retaliating by seizing international cargo ships.
Yeah, specifically the MSC Francesca and the Epimainodes.
Right. And the commodities markets reacted, well, exactly how you would mathematically expect them to when there's a disruption of that magnitude.
Complete panic.
Pretty much. Oil spiked dramatically.
Yeah.
Brent crude is currently sitting around $98.80, and WTI is near 94.
And honestly, if you've been to the gas station this week, you've seen the local impact of this. U.S. gas prices shot up 60 cents a gallon in just 2 weeks.
It hurts. It really hurts the consumer.
Yeah, and gold went absolutely wild, too. It surged past $5,000 an ounce during that initial wave of panic.
Though it's settled back down a bit, right around 4,700.
Right, as investors sort of transition from sheer panic into using it as a more sustained macroeconomic haven.
But looking at the sources you sent over, there is actually a glimmer of hope on the diplomatic front.
Yeah, renewed peace talks are actually happening in Pakistan right now. And they involve Steve Witkoff, Jared Kushner, and the Iranian Foreign Minister Abbas Araqi.
And just the news of those talks is putting a slight cooling effect on the spot price of oil today. But the fundamental physical bottleneck, it remains.
Okay, wait, I have to push back here. Let's look at this practically for a second.
Sure.
If you take a massive industrial clamp and you just squeeze the world's main fuel hose shut.
Shutting down 20 million barrels a day.
Right. Why aren't you and I seeing rolling blackouts? Like, why hasn't this triggered an overnight global economic collapse?
That is a great question. And what's fascinating here is the hidden plumbing of the global energy architecture.
The plumbing.
Yeah. The system actually has some pretty heavy-duty shock absorbers built right into it.
Okay, how so?
Well, right now, Saudi Arabia, the UAE, and the IEA are actively deploying their spare capacity. They are injecting about 3.5 million barrels a day into the market.
Oh, wow. I didn't realize they had that much just ready to go.
Yeah, and they're also actively rerouting oil via overland pipelines to bypass the Strait of Hormuz entirely.
Oh, so they're basically taking the physical back roads to avoid the naval blockade.
Precisely.
Oh.
It's a huge logistical pivot. But, and this is crucial, those overland pipelines only cover a fraction of normal maritime volumes.
Right, a pipeline can't replace a fleet of supertankers.
Exactly. These are just stopgap measures to prevent an immediate global blackout. The structural bottleneck is still very much there.
So it's a temporary fix.
Yeah. The longer the Strait of Hormuz stays closed, the more this shifts from being a temporary, manageable price shock to a permanent grinding drag on the global economy. I mean, that spare capacity will eventually run out.
Okay, so if the physical supply chain is practically anchored to the ocean floor right now, your first instinct as an investor is probably to brace for impact.
You'd think so, yeah.
But when you look at the stock market today, Wall Street is completely ignoring the Persian Gulf.
Totally unbothered.
Here's where it gets really interesting. The S&P 500 is trading near record highs, hovering right around 7,165. The Nasdaq is just soaring.
Now, the Dow is dragging a little bit.
Right, but that's mainly because it's heavy on cyclicals and financials, which actually feel the heat of physical energy costs.
Yeah, those companies live in the real world.
Exactly, but the tech sector, it is absolutely flying.
And the major catalyst driving the tape today is Intel.
Intel just delivered an absolute blowout Q1 report. I mean, they are projecting between $13.8 billion and $14.8 billion in revenue.
And it is almost entirely due to a massive influx of AI data center orders.
Yeah. Their stock jumped 23.75% today alone, just today.
That is massive for a company that size.
And because they're a bellwether for the entire semiconductor space, they basically pulled everyone else up with them. AMD jumped 15%, Broadcom up 11%.
And NVIDIA rallied 4 to 5% just on sympathy alone.
Right. It is a targeted, tech-fueled surge that is single-handedly propping up the broader indexes.
But according to the Zacks equity research data we looked at, it's not even just tech.
Wait, really?
Yeah. 83% of S&P 500 companies are beating their earnings estimates right now.
Okay, that's wild.
Boeing just posted a record $695 billion backlog. Newmont generated a record $3.1 billion in free cash flow.
Which makes sense given the whole rush to gold we talked about.
Exactly. And Interactive Brokers hit a record $613 million in revenue. Probably because retail investors are just trading like crazy to play all this volatility.
Okay, but hold on. I am not buying this unbridled optimism.
No.
No. Are investors just burying their heads in the sand? I mean, isn't this exact same behavior, ignoring global reality to buy tech stocks at literally any valuation? Isn't that what caused the dot-com bubble?
You are not the only one asking that. Bank of England Deputy Governor Sarah Breeden actually issued a formal warning about this exact dynamic.
Oh, really? What does she say?
She cautioned that global markets are severely underestimating these macroeconomic shocks. And she explicitly noted that current AI valuations are mirroring the dot-com peak.
Wow.
Yeah, she thinks the systemic risk is glaring.
So Wall Street is just hallucinating right now?
Well, if we connect this to the bigger picture, the actual earnings data tells a slightly more nuanced story.
Okay, walk me through that.
When the broader market did sell off recently due to the initial conflict, the V-shaped recovery to get back to near record highs took only 11 days.
Just 11 days to bounce back.
Right. And why did it snap back so fast? Because the earnings growth backing it up isn't theoretical. We are actually looking at double-digit earnings growth for the 6th consecutive quarter.
6 quarters of double-digit growth. That's hard to argue with.
Right. For the tech sector specifically, investors are adopting this psychology of what they call the insulated oasis.
The insulated oasis. I like that.
Yeah, the prevailing thesis is that an AI data center's software revenue isn't loaded onto a cargo ship that has to navigate a naval blockade.
Oh, I see.
To an equity trader, the AI boom feels completely detached from the physical supply chain disruptions occurring in the Middle East.
Okay, an insulated oasis. But those AI companies might live in a digital cloud while your checking account, lives in the physical world.
Unfortunately, yes.
And in the physical world, that energy shock is hitting the everyday consumer incredibly hard. Which brings us to the S word.
Classic stagflation.
Stagflation. We're essentially driving a car uphill, but the emergency brake is stuck on.
That's a great way to put it.
Right. Prices, the engine are revving out of control, but economic growth, the car itself is just stalling out.
And the macroeconomic data we're seeing right now reflects that tension perfectly.
Let's look at the engine revving first. March CPI is officially estimated at 3.4%.
Which is up significantly from 2.4% in February.
Yeah, that is the energy shock translating directly into the cost of everything you buy. Now let's look at the stalling car. The labor market is cooling fast.
Really fast. The hiring rate just fell to 3.1%.
Which is the lowest level we've seen since April 2020, back in the really early pandemic days.
Yeah. And we're also seeing real structural pain in manufacturing.
How bad is it?
Well, manufacturing jobs are down by 82,000 over the last 14 months.
Wow.
And that is incredibly telling, because that decline is happening despite the sweeping new Liberation Day tariffs that were implemented in 2025.
Right, and those tariffs were specifically designed to boost domestic factory jobs.
Exactly. But the underlying issue is that businesses are simply contending with incredibly high physical input costs right now. They just can't afford to hire.
And the psychological toll of all this on the consumer is massive. The University of Michigan Consumer Sentiment Index is sitting at 49.8.
Yeah, that's grim.
To put that in perspective for your portfolio, that is the lowest consumer confidence has been since 2008.
The Great Recession.
Yeah. Meanwhile, one-year inflation expectations just jumped to 4.7%. People are feeling miserable, and they expect their grocery bills to just keep going up.
And we can see this dynamic playing out in the corporate boardrooms, too. Just look at Procter & Gamble.
P&G, basically the ultimate consumer bellwether.
Exactly. So P&G actually beat earnings this quarter. They even announced their 70th consecutive dividend hike, returning $3.2 billion to shareholders.
Okay, and Wall Street obviously cheered.
They did. But if you look under the hood at their core operations, their gross margins actually fell to 50%.
Wait, really?
Why? Because of those new tariffs we mentioned, and an unfavorable product mix. It proves that even the absolute undisputed giants of the consumer sector are feeling the cost squeeze from this energy-fueled inflation.
So they're literally paying more to make their products.
Yep.
Okay, but I'm looking at these real estate numbers, and I'm genuinely confused here.
Yeah, housing is a weird one right now.
If everyday costs are squeezing everyone, and consumers are as miserable as the University of Michigan says they are, how are home sales surviving at all?
It's counterintuitive for sure.
The sources show that pending home sales actually rose 1.5% in March. And that is despite the fact that home seller profit margins fell below 45% for the first time in 5 years.
Right.
So how is anyone managing to buy a house right now?
Well, this raises an important question about the difference between discretionary spending and absolute necessity.
Okay.
So with a company like P&G, you're looking at what economists call inelastic demand. No matter how bad the economy gets, people still need to buy toothpaste and shampoo and laundry detergent.
Right. They might complain about the price, but they buy it anyway.
Exactly.
But a house isn't a tube of toothpaste. It's the biggest purchase of your life.
True. But housing is currently being driven by a massive wave of pent-up demand.
Pent-up demand.
Yeah. For years, people delayed moving because they were waiting for mortgage rates to magically return to 3%.
Which wasn't going to happen.
Right. And life doesn't pause for macroeconomics. People get married, they have kids, they change jobs, or they just need to relocate.
Life goes on.
Exactly. At a certain point, buyers just adapt to the new normal. Right now, conventional 30-year fixed rates are hovering in the low to mid 6% range.
Which feels high compared to 2021, but historically isn't terrible.
Right. Buyers have simply accepted that this is what capital costs now. And they're finally making those delayed life moves, even if the profit margins for the sellers aren't what they used to be.
So the car is stalling, the engine is revving, and consumers in the back seat are just holding on for dear life and paying whatever it costs to keep moving forward.
That's a great summary.
Which means we really need to look at the driver. Who is supposed to fix this stalling economic engine? The central bank?
The Fed.
But right now, it looks like the Federal Reserve is completely paralyzed.
They are. They're paralyzed by the underlying economic data, and they are paralyzed by unprecedented political drama.
Okay, let's start with the data. The Fed just met and voted 11-1 to hold the federal funds rate exactly where it is, right at 3.50 to 3.75%. If you look at their dot plot which is basically the Fed's internal forecast for the future, it implies there might be one rate cut left in 2026.
Maybe one.
Yeah.
Yeah.
But if you look at the futures markets where actual money is on the line, traders are looking at the energy inflation numbers and betting there might be zero cuts this year.
Zero. And that data paralysis is happening against the backdrop of massive succession crisis in Washington right now.
Yeah, the drama here is just wild. Chair Jerome Powell's term ends in just a few weeks, on May 15th.
Coming up fast.
And the nominee to replace him is Kevin Warsh. But Warsh is currently being blocked in the Senate by Senator Tom Tillis.
And the reason why is just it's something else.
It really is. Tillis is protesting what he explicitly calls the vindictive prosecution of Powell regarding the renovation of the Fed's headquarters.
It is a messy, messy leadership transition.
Yeah.
And it's happening at the exact moment the global economy needs absolute stability.
Yeah.
And Kevin Warsh's specific monetary philosophy is really vital for your portfolio here.
Oh.
He is known to favor an aggressive reduction of the Fed's balance sheet, specifically the $2 trillion in mortgage-backed securities they currently hold.
So basically, if he dumps those mortgages.
Exactly. If he takes the chair and pushes that hawkish agenda to dump those securities, it will flood the market and drive down their price.
Which inversely drives up yields.
Right. It could tighten financial conditions and push mortgage rates even higher, even if the Fed doesn't actually raise the core federal funds rate.
Wow. So what does this all mean? Are they actually being data dependent right now, or is the Fed just using this Middle East conflict as a convenient excuse to sit on their hands?
Just stall for time.
Yeah, do nothing while they wait for their own leadership drama in the Senate to resolve itself.
Well, if we look strictly at the economics, the Fed is trapped in a genuinely uncomfortable dilemma.
The dual mandate.
Right. They have a statutory dual mandate. Control inflation and maximize employment.
And they're failing on both.
Basically. Right now, they cannot cut rates to help the slowing labor market because the geopolitical energy shock is driving inflation right back up.
Right.
But they also cannot hike rates to fight that energy inflation because the labor market is already showing severe cracks.
So they're completely boxed in.
Completely. And to see how worried regulators are about this trap, you just have to look at the Fed's recent severely adverse stress test scenarios.
They run these models to figure out exactly what it would take to break the banking system, right?
Yes, and the specific scenario they are currently modeling features a hypothetical 58% drop in equities, alongside a 39% decline in commercial real estate.
58%.
Yeah. Now, to be clear, these are not predictions.
Sure.
But the fact that regulators are actively testing bank balance sheets against a systemic break of that magnitude, it shows that behind closed doors, they're quietly terrified.
Terrified of what?
Of what happens if these two realities, the soaring digital stock market and the dragging physical economy, violently snap back together.
Wow. A 58% equity drop modeled by the central bank. That is a sobering thought.
Very.
Okay, we need to tie all these massive geopolitical, corporate, and monetary threads together because for you listening right now, you still have to manage your portfolio, your business, and frankly, your mindset in the middle of this fractured two-speed world.
Yeah, and the clearest takeaway from all these conflicting sources is the absolute necessity of diversification.
Right. You cannot afford to be entirely exposed to just the AI boom, assuming tech is totally immune to the physical world.
Exactly. Nor can you just liquidate everything and hoard cash in fear of the Middle East conflict.
Geographic and asset diversification is really how you build resilience when the stock market and the physical economy are moving at two completely different speeds.
Patience and a bias toward quality are key right now.
And speaking of different asset classes, there was one final detail in the sources that perfectly captures how investors are navigating this chaos.
Oh, the crypto news.
Yeah. The U.S. Treasury just sanctioned a bunch of Iranian crypto wallets, freezing $344 million in digital assets.
Which is a huge regulatory flex.
It is. You'd think a regulatory crackdown of that size would spook the crypto markets. Yet despite that, Bitcoin is holding incredibly strong, hovering right near $78,000.
Because investors are actively looking for non-traditional macro hedges. They want an asset that feels disconnected from the Fed's leadership drama and the physical oil supply bottlenecks in the Strait of Hormuz.
It is all connected, even when it feels totally disconnected. So we're going to leave you with one final thought to mull over or research on your own, something that builds on everything we've just unpacked today.
The ultimate collision course.
Right. We have this booming AI tech sector. It's the insulated oasis that's keeping the S&P 500 at record highs, but AI requires absolutely massive amounts of physical electricity and physical infrastructure to run.
Massive amounts.
At the exact same time, we have a geopolitical crisis threatening the entire global energy supply. So ask yourself, what happens when the unstoppable force of the AI capex cycle collides head-on with a prolonged physical energy crunch?
It is going to be a fascinating dynamic to watch in the coming months.
Absolutely. Thank you so much for bringing these sources to the table for us to dig into. Until next time, keep questioning the consensus.
Take care, everyone.